Good morning, folks. Chartered Accountants Society is delighted to welcome John Finn, who will provide us this morning with a banking and financial markets outlook for 2022. John is a chartered accountant. He's also a member of the Irish Association of Corporate Treasurers, as well as a past president of that association. In total, he's got almost 30 years' experience in treasury and financial management. John is going to be familiar to a lot of you. He's a regular contributor to Morning Ireland's Business News, and you'll often see his comments referred to on RT's Business News website. So, throughout John's presentation, feel free to ask your questions in the Q&A answer box below. I'm going to be monitoring the Q&A box throughout the presentation. We're going to get through as many questions as we can after John's presentation, so I'm going to hold all the questions until then. So without any further delay now, I'm going to pass you over to John and welcome him to this webinar.
Thanks very much, Mike, and good morning, everybody, to this morning's presentation. Let's get straight into it. We have a lot to cover off. So basically what I'm going to cover is foreign exchange, interest rates, and linked to interest rates, we'll obviously be looking more closely at inflation as well, which is something that has probably not reared its ugly head for over a decade, but it is now topical and will continue to be topical, I think. We look at trends in the banking market in general here, and that again is an interesting market. And then we'll summarize it at the key points at the end. And as Micah said, we take Q&A at the end. So the objective here is, I think there's an hour in total. I'll try and get through this in the next 43 minutes. So we'll be finished around 8:45, and that'll give us 15 minutes to do Q&A if that's all right with everybody else. Okay, so starting on the foreign exchange side, we're going to look at recent trends, the current outlook, and then maybe look a little bit at policy and strategy development, because this is an area that's generally, and I've said it before many times, at training sessions for the Institute and indeed any events I've spoken at before, it tends to be an undermanaged aspect of finance. So starting with the UK or Euro and Euro Sterling, I think the look back, what are the key things that have arisen over the last 12 months? And they're important. Why? Because they'll shape what's happening in the next 12 months. Brexit, we all know, it's been a major driver of Euro Sterling over the last 5 years, as the slides will show in a second. It is over for now. The impact of it is still lingering and will continue to linger. But as a mover of the markets in Euro Sterling in particular, it has at least abated. Interest rates and inflation, very much a key now. And in fact, a lot of the moves in exchange rates over the last 6 months and likely for a lot of 2022 will be driven by interest rate expectations, and the difference in interest rates between different currencies will drive it. And of course, the movement in interest rates in turn has been driven by inflationary pressures. So this will probably be one of, if not the most key driver of exchange rate movements in 2022. It goes without saying that politics always drives it, and politics is a difficult one then to assess the impact of, because it's so uncertain. What we do know is that uncertainty in political terms always impacts on exchange rates in particular, but because politicians and what they do are quite uncertain and unpredictable, the impact of what they do can be, as a result, can be big, but also not entirely easy to predict. And we can see that even in the UK at the minute, where Boris Johnson is under severe pressure, and whether he'll last or not is another question, but it will impact one way or the other on the exchange rate. And lastly, the pandemic has had an impact in many different ways. The government intervened and indeed contributed an awful lot of money to economies to prop them up over the last 2 years. Demand has actually been, I suppose, stifled in many sectors, and consumers have saved a lot. So economic growth figures for the back end of last year and certainly coming into this year have been quite strong. But then we've also had supply chain shortages and the knock-on effect that's had in numerous different ways. But all of those impact on exchange rates. So here's a chart, a 10-year chart basically of Euro Sterling. And I've gone back 10 years because I wanted to go back to the pre-Brexit times initially. So the left-hand side of the chart, as we're looking at it, 2013, 14, 15, we saw a period of significant strength in sterling. And this was a really good time for exporters, because basically they were gaining a lot more euro income for sterling sales, and very significant. I mean, this is the thing about currency everyone needs to remember, and I keep saying it, is that if you are selling to the UK and you've no sterling inputs, you have euro costs, the movements in the foreign exchange are straight to the bottom line. So if your sales drop by 25 grand, your profits, all of the things being equal, will drop by 25 grand, which makes it very important variable to manage for your business, and particularly on the financial side. Brexit, as we all know, saw sterling go from literally 70, 71, 72p, excuse me, to about 80. It dropped to about 78p pre-vote and moved about 6p overnight to 84p the morning of the vote, or the morning of the result. And you can see basically it's been in a channel of 84p to 93p pretty much since 2016, 2017. Now, the more interesting bit, I guess, is on the right-hand side of that chart. And if I move on to the 12-month trend, you can see that post-Brexit, things have settled down again, and sterling has strengthened gradually over the course of 2021 and into 2022. So again, this has been good news for exporters, because exporters suffered significantly in a move from 70p to 90p, which happened over a couple of years there and put companies under severe pressure. And indeed, if you may recall, there was a lot of talk about what exchange rate does. The food sector in particular might have experienced a lot of pain, because food sector tends to be fairly low margin compared to other sectors, and therefore prone to moves, material moves in the exchange rate. So as you can see here, we've got a channel at the minute that's sitting around the kind of 83p to 85.5p level. And it's been trading within that channel. And you can see it's hit the top of the channel and come back down a couple of times. Now, this using this analysis and these ranges, it's called technical analysis. And, is it a good predictor? It's a funny one. I'm not necessarily a huge fan of it, but the funny thing is sometimes dealers are. And what happens is it gets to the top of a range, they sell it, and of course if they sell it, it comes back down again. And literally if it gets to the bottom of a range, they buy it, and if they buy it, push it back up. So there can be an element of self-fulfilling prophecy about it. But what you can see basically is that euro sterling has traded strongly over the last 12 months, and mainly on the back of two things. One is the removal of the Brexit uncertainty, and second is interest rates in the UK have started to decline, both short-term and long-term rates. We've had 2 base rate hikes in the UK in the last couple of months. And when we come to look at the interest rates, the longer term ones, you'll see that they've actually risen quite a lot. And this is a slide it's a table, of highs, lows and averages from 2008 to date. I've actually got, this table goes back to 2000. And I've been, I suppose, just tracking euro sterling since then when we joined the Eurozone. And it was about 62, 63p when we joined. And if I use the second column on the right is the average rates over the years, okay? And the one in the middle, the high to low, is basically the difference between the high and low movement every year. So what's the highest rate and the lowest rate? So 2 things to note from that. You can see annual volatility from the high and lows it's about 10%-ish with the occasional outlier. So we had a 32% high low in 2008, and we had a 28% in 2016, which is due to Brexit. But by and large, over the years, you're talking about a 10% average between the best and worst rates of the year. By comparison, then, the averages are actually reasonably stable. So even within the Brexit years there, 17, 18, 19 and 20, where we had a fair amount of volatility in euro sterling, the average rate for the year was in and around 88, 89p. So it didn't move that much. Now we can see there's been a big move last year and this year to date. I mean, we're averaging just at under 84p at the minute. Now, the reason why this is topical is that most companies, I find an awful lot of companies don't hedge in a structured way to try and buy what they think is good rates or sell at good rates. And it's a bit more, I use it speculative, I use that word for the want of a better way of putting it. And if you're adopting that sort of approach, you're more likely to sit in the high-low range than in the average range. The whole idea of the averaging is that if you hedge on a regular basis, you achieve a rate that's closer to the average. And one would assume for most businesses, that's what makes sense. But I suppose what I'm saying here is that we've had, ironically, despite Brexit, we've had relative stability in the average rate over the last few years. But we've seen a big move in the last 12, 14 months, which is good news for exporters, but bad news for importers, unfortunately. Going on then to the outlook. I would say this is now, again, it's the view of some of the banks, just to get an idea. AIB in January predicting that we'd be in a range of 79 to 85 until June. Bank of Ireland, and that was from December. I couldn't find a January update. We're staying steady around 84p until the end of March. Barclays calling it down to 87p by the end of Q1, but making its way back to 84p by the end of the year. So, that's quite a wide range in its own right, and predicting foreign exchange rates can be problematic because of all the variables. So the key variables looking forward for this year
are the economic outlook for the Eurozone versus the UK. The UK outlook is stalling probably a little bit, and to some extent, Europe the same. An awful lot depends on, I guess, how supply chain issues are resolved. Inflation is obviously a key issue because inflation can impact on consumer demand. Consumption drives 70% of our economy. So if consumers stop spending, your economic growth stalls. So that's obviously one of the key things going forward. The second thing is inflation, and I have one or two slides on inflation in a minute, but we are now seeing inflation at rates we haven't seen in quite some time. In fact, the inflation rate in the United States hit its highest level since 1982. Last month, it was 7%. We're seeing it at over 5% here. And the one worry I would have in an Irish context is that, as you know, the exchange rate, as in the euro itself and the euro interest rates, are set at levels that are best for the Eurozone. We are 1% of Europe in terms of economic size, so we don't really count. And we had a problem, as you know, in the Celtic Tiger, because we had inflation rising here at a faster rate than was happening in Europe. We needed higher interest rates as a result to cool our economy. Because we were in the Eurozone and Germany wasn't trading that well at the time, interest rates stayed low. And that's what actually propelled the Celtic Tiger in many ways. It was one of the contributing factors. High inflation rates here, but not been matched by higher interest rates. Our inflation rate is slightly above the EU average at the minute. If that gets out of kilter again, and the differential grows, we do run that risk of getting into an inflationary period here, which requires higher interest rates, but interest rates not rising as fast as we need them. And the interest rates is the next point there, but it goes without saying that the two of these are linked. I'm going to move on to interest rates in a second, but then just to put it in perspective here again, I produced these slides. I did a bulletin for my clients on Friday evening and produced the slides off that and sent them to Fiona Monday morning. The 3-year swap rate for Eurozone was 0.07% on Friday evening. I looked at it this morning, it's 0.35%. So we've had a 0.25% hike in euro interest rates in the last 3 days on the fixed rate side, or on the longer term side. Last thing, the political outlook could be important. This is a tough one to call, because if you look at even what's happening in the UK, it does look like Boris Johnson's under pressure. Of course, it's not the first time that's been said. Should he stand down or be forced to stand down, would that be good or bad for sterling? Who takes over would obviously be an important thing. I think the view at the minute is that the Chancellor of the Exchequer is most likely to take over should Boris jump or be pushed. That on balance, you would say he's seen as a fairly safe pair of hands. So, it mightn't necessarily be bad for the UK at all, but time will tell. But the problem, I suppose, with all of this at the end is that we have a lot of variables coming in here. Politics is always there. Inflation and interest rates have not really been there now for over a decade, and that now is a key driver. And as a result, making the call here can be difficult. So generally what I say on currencies, and we'll get to it in a second, is that, the aim here, if you've got currency exposure, is to make sure you don't lose money. It's not necessarily to make money, but you want to make sure you don't lose it. So we'll come back to that at the end. We move on to euro dollar, 10-year trend here again. Dollar was not dissimilar in some respects to sterling, in that we had a period of significant dollar strength. It went from about 140 down below 110 in 2014, 2015, traded in quite a narrow channel from 15 to 17. And we've had a little bit more of a bumpy ride in the last couple of years. There's been some, and if I actually go on to this one, which is a 2-year trend, you can see, we've seen it go from 108 up to 122.23 over a 12-month period, and then drop back almost to the same levels. So, that's quite volatile. And again, driven by interest rates initially, because the interest rates in the States started to rise before they rose in the UK or indeed in the Eurozone. So that's certainly given some momentum to the dollar. We've obviously had a lot of political uncertainty in the States. We had a presidential election in 2020. We have a political outlook in 22. We got to watch this midterm elections again. So this one traditionally also has been a more volatile than euro sterling. And if I go to this table here, which is the same type table as I've had for euro sterling a couple of minutes ago. The thing about euro dollar versus euro sterling is that the high-low variability tends to be higher. So where we would have said a high-low per annum of maybe 10% in euro sterling, over the years, it averaged close to 15% in euro dollar. And you can see again that the averages, whilst again, they're tighter than the high low volatility, as you would expect, they're a little bit more volatile than in the UK. So again, the same thing here, which is basically that persistent or consistent hedging tends to give you smooths the rate that you achieve, and that in turn tends to get out the I suppose the outliers or the more volatile aspects of the currency managed. So again, for the outlook on the euro dollar, I would say it's a wider view. So AIB were calling 111 to 117 by the end of June. As a Bank of Ireland from December, we're calling it 111 by the end of March. Barclays were seeing it at 119 by the end of 2022. The view on, certainly I keep an eye on Reuters and Bloomberg quite regularly. There seems to be a view from a lot of the American economists that the dollar will weaken over the course of this year, that there just are, it's had a reasonably good run, and that there are a lot of variables there that would suggest uncertainty. And that as a result, for some reason, the calls on certainly on that side of the Atlantic seem to be more possible weaker dollar, which would be good news for you if you're importing, but bad news if you're exporting. The second thing, sorry, I just might say here about dollar too, is a lot of currencies in the Middle East are also linked to the dollar. So when I look at euro dollar here, this could equally apply to the euro against a lot of those Middle Eastern currencies because of the linkage between those currencies and dollar. So just bear that in mind. Again, like for sterling, the interest rates and the inflation are the key variables. And I said already, the interest rates have been started to move more quickly or ahead of everybody else in the States, which would suggest again that if they move more quickly, they should slow down first, all other things being equal. And if they slowed down or were stabilizing while rates in the UK or in the Eurozone were still rising, that would tend to lead to a weaker dollar as well. Okay. Inflation outlook in the States is, there's been an argument, as you probably are aware, since the middle of last year as to whether inflation was transitory or not. I've always been in the camp that it's not transitory. I've never believed that line. I still don't believe it. And with inflation at 7% there, and as I said, the highest since 1982, it's kind of hard to see that interest rates won't be rising for a while in the States. To give you an idea of how disparate the predictions are, we'll see it in the interest rate side. Some banks are calling for 3 rate hikes by the Fed this year. Some are calling up to 7. And that's quite a wide range in its own right. So that tells you how split economists and financial markets in general are on this one. We've also got midterm elections 2022. Why is it important? It's important because the way the houses are set up in the States as regards control of them, both the upper and lower houses between the Republicans and the Democrats, because if you have a Democratic president but Republican controlled houses, it's pretty hard to get anything through your government or your parliament. So, and that will also give us an idea of how maybe America's thinking in advance, 2 years in advance of another presidential election. And the geopolitical outlook is also important. And that's probably been as unstable as it's been in quite some time. We're seeing the rise of China and Russia in terms of geopolitical strength. We see what's happening in the Ukraine at the minute. And I suppose in some respects, the States have pulled back from its role internationally compared to what it would have had a number of years ago. And all these things impact on financial markets, including on currency markets. And if you want, I don't read loads as in, I read newspapers, I don't read a lot of books, but I read a book last year called The Power of Geography. And if you are, if you're interested in that sort of stuff, it's a really good read because it covers 10 different areas in the world as to where historically how things have been and also where they are right now and how there could be turmoil there and how that could impact on economics and politics and that sort of stuff. It's a really good read, but it's also, it wouldn't necessarily let you sleep any better at night given the contents of it. But that's the world we're living in today. I think it's probably a more volatile world geopolitically than we've had in quite some time. And that in turn tends to add to volatility in the financial markets, both in currencies, equities, interest rates across the board again. So if I move on just very quickly to currency strategies, I guess, and policy. Now, the reason why I just put this up here is that policy, most companies don't have a policy in this space. And you can see, I reckon 10 to 15% of companies have an FX policy at most. And I think you should have it. If you have a material level of sales or purchases in another currency, it's a good idea to document this. Policy is generally a board-driven document, sets out the big picture regarding how you manage your currency, what your attitude to risk is. And the idea really between then this, once you have the policy that sets out the big picture, then your strategy really just links the operational side of the business to the policy. In other words, how do we manage the currency movements? How does it impact on sales, on purchases, on our profits? What's the most appropriate way of managing it? And I suppose just putting a little bit of structure around it. And as I said, 10 to 15% of companies probably have a policy in this space. 100% have the risk. And as a result, it's one of the most undermanaged areas of finance. And I've thought over the years, I've struggled as to why this is the case. And I suppose there are a couple of reasons why I think it is. One is, I think as accountants, chartered accountants, we don't have a lot of training in this space, to be honest with you. If you think back to doing your exams, there might be one chapter on treasury. That's about it. So it's an area where we're probably underskilled, if I can put it that way. And there's also an assumption, because it's an area of finance, anybody outside of finance assumes that we should know how to deal with it. So I think that's one of the challenges. And also, for some reason, I think we like a bit of a bet and a bit of a gamble. Everyone wants to talk about the money they made on currencies, and nobody wants to talk about any losses they made, which is a bit like what gamblers do. So what I'm saying really here is that this space probably needs a bit more. It needs a bit more attention across the board. So, if you wanted to put a strategy into place in this thing, there's a structure to it. And really what you do is you try and identify the exposures. And when I say they're not always obvious, let me just give you a small example there. You could be importing raw materials from the UK, and they say, look, we'll invoice you in euros. So naturally, if I'm writing a check for euros or paying euros, I'm naturally hedged because I get my income in euros, I pay out in euros, so it's hedged. But in most cases, what you'll find is that that company in the UK is simply using a euro sterling exchange rate to set that euro price. So you get to 12 months time, they will reset their price. If sterling has gone against them, they'll seek to up the price. And if sterling has gone in their favor, they may not reduce it. So in a scenario like that, on the face of it, yes, you're hedged because you've got euro in and euros out. But in reality, the euro price you've been charged reflects the movement in euro sterling. And worst case scenario, as I've alluded to there, is you may end up in a situation where you have a price ratchet. In other words, they'll change the euro price upwards if things move against them, but they won't move them downwards. So that's the first thing you need to be careful of. Second thing is then you need to quantify the exposures. How big is my sterling exposure, my dollar exposure? Can I reduce some of that risk by offsetting, income or expenditure in the same currency? Then you develop the strategy. In other words, what makes sense for me to hedge my profits? Think about it like that. I want to make sure I achieve my margins, and I want to minimize the negative impact on my margins to adverse currency movements. Then you need to implement it, and obviously you need to evaluate it. And it's a rolling process. You just have to keep it updated, because yourselves, if you're buying or selling currency every month, if you were to predict it for the next 6 months, it would change, because that's the way business works. We forecasts are always wrong, so you're looking to refine it and that sort of stuff. So look, that's probably an overview of the currency side. In summary, what I'm saying really there is a lot of volatility potential. It's been euro sterling's had a good move for exporters over the last 12 months. They've got some relief after a tough couple of years. Don't always assume it's going to stay that way. So don't be too greedy. But more important, I think the message really here is try and put a bit of structure around how you manage this stuff, and also try and report on it a little bit better. Link your currency bit to your operation stuff, as opposed to just looking at the P&L actual versus budget actual against past year, because it won't work in this space. Okay. So I'm just watching the time. I think we're okay on time. Yeah, I'm on time. We move on to interest rates. So on interest rates, I'm going to cover the 3-month Euribor, which is the short-term euro rate. I'm going to then look at 3-year swaps, because that's medium-term rates, and that's probably more important actually in many respects, because it's a better indicator of where rates could be going. I'll briefly talk about sterling, LIBOR, and SONIA, because the LIBOR, 3-month LIBOR, or LIBOR in general actually for sterling, has disappeared from the 1st of January 2022. It's no longer applicable. I'll have a quick look at sterling swap as well, and then we look at the outlook and maybe some comments on interest rate hedging as well. Okay. So first chart here again is the 3-month Euribor rate. It's a 5-year trend. So as I've said, this is the short-term rate that's kind of linked is probably a fair way of putting it to the base rate in the Eurozone. And this has been negative now since about 2015. Okay, it's been below zero. And it's been below zero because the ECB was basically pumping money into the system. And like any price of anything, supply and demand. If you pump in more and more supply, you drop the price of it. So that's why we've had negative interest rates in the Eurozone for 6 years now. That negative interest rate has not flowed through on the borrowing side here in Ireland. In other words, I think it's fair to say every agreement that you would have seen over the last number of years would have a clause that says if the euribor rate is less than 0, then your cost of funds is deemed to be 0. I think I've only seen 2 deals over the last 5 years where the benefit of negative rates flowed through to the borrower, and they were both strong, very, very strong, very large companies. Okay, so the idea of having negative interest rates was to try and encourage people to borrow so that they would invest, so that it would stimulate economic growth. Of course, if you don't have the effect of that flowing through to borrowers, well, then you don't get the same level of growth or stimulation. Of course, what we have also seen is that negative rates have applied to deposits, to larger corporate deposits, probably 3 years ago, and it's filtering across to everybody now, including to current accounts, where I think on average you have, I think the deposit rates most of the banks are now giving is minus 0.65%, or maybe worse again. And that's across the board, unfortunately, whether you're a large corporate or a small corporate. So that's the 5-year trend there. And as you can see, I said it's that 0.2 is minus 0.2 there on the higher level. You can see that the rates bottomed out at the end of 21. They hit an all-time low there of, actually they dipped below minus 0.6. And they've since come back to, as you can see, the rate there is minus 0.547. When I did these charts last Friday, it's actually minus 0.53 this morning. So it's beginning to creep up, and it will begin to creep up over the course of the year, because there's a general view now that the ECB will probably hike at least once by the end of the year. The base rate's been 0 now for quite some time in the Eurozone. You're probably only looking at a 0.25% hike. So in terms of the progression, the States has been ahead of the UK has been ahead of the Eurozone. So we're lagging here. And but that being said, these rates can't persist forever. And I guess that will be a relief in due course to depositors who have been hammered on these negative rates for the last 6-12 months. And it will get better, but it will take time. So I wouldn't expect to see this in positive territory. At best, we might see it back in positive territory towards the back end of the year, and that's at best. But it is going to trend back upwards. Okay. So what's more important though to look at is the 3-year swap. And the reason why 3-year swaps or 5-year swaps are better to look at is because they are looking out 3 years or 5 years. By definition, the 3-month rate only looks out 3 months. So if you want an indicator of where rates are likely to go, you don't watch the base rate, you don't watch the Euribor rate, you watch the swap rates. Okay, so don't worry about the jargon about swap. Swap is just a fixed rate. So 3-year swap means a 3-year fixed rate. And this is the rate at which the banks can fix with each other. So this is before margin. This is effectively cost of funds. And what you can see there, the white line across there is 0. So that hovered around 0 from 2017, 2018, dropped below, then started 2019. And you can see, it dropped incredibly low, almost minus 0.6 at one stage. And even, in 2021, start of the year, you could get under minus 0.5%. But that has climbed significantly in the last, last couple of months. In actual fact, the rate, as you can see on this one, is 0.086 as of last Friday. And that would have been I think it was about minus 0.2 in December, around Christmas. And as I said to you this morning, I just checked it this morning, and it was plus 0.35. So it's actually after moving about 60 basis points, 0.6% in the last 6-7 weeks. And nobody's talking about interest rates rising here. Now, what's the impact on this? Well, first of all, it'll impact on the cost of borrowing if you want to fix, because the cost of borrowing, or cost of fixing, I should say, for 3 years has now increased by over 0.5% in the last 6 weeks. It will impact on fixed rate mortgages quite quickly, because if it's costing them more to borrow for 3 years, they'll start hiking up the cost of borrowing for 3 years. It just goes without saying. So this is probably one of the key takeaways you need to take from this morning. These interest rates have been low, 0, below 0 for 5-6 years, and it's changing. It's moving, and I think I never thought we'd see negative interest rates in my time. I mean, I remember we were chatting before we came online here, the early 90s, when I was a young, recently qualified accountant. Spent a couple of years in England to save a deposit for a house, came back here in 1992, and the mortgage rates were like 10, 11, 12%. We had a currency crisis there as well. So, typical interest rates of 5, 6, 7% over the years for mortgages would have been normal. And we've had, in many respects, an abnormal period now since the financial crisis of 2008. And the danger, of course, is that when interest rates have been so low for so long, people get complacent and they assume they will stay low for longer. I think you can see from this chart that's not the case. And as I said, if I'd updated it this morning, I would have had to reset the scale on the right-hand side because I would have needed it because it's gone to 0.35%. So key takeaway is these are on the rise, and this has impacts across the board, which we'll see in a minute. I want you to think a little bit laterally about some of this stuff in a minute, and I've put a slide up to that effect. In the UK, just very quickly, I don't want to dwell on this too much because I suspect most people don't have sterling borrowings, but just to be aware of it. Sterling LIBOR has been discontinued since the 1st of January 22. It no longer applies. And it's been replaced. They're looking at a number of different replacements as are known as the alternative reference rates. The market norm at the minute seems to be for a backward-looking SONIA. So SONIA is basically an overnight rate, a sterling overnight rate. And what's the key thing here? Basically, what you need to know right now is if you think about how we would normally calculate interest rates and interest costs. So last year, if you were to borrow 3 months sterling, let's say on the 1st of October for 3 months to the end of the year, you would look at what the 3-year sterling rate was. And let's say it was 0.5%. You would add your margin to that. Let's say your margin was 2%. So you'd know your cost of funds for the last 3 months of the year was going to be 2.5%. Yep. So you knew that on the 1st of October and you could accrue accordingly. The way SONIA works and these new ones working is they're working backwards. So in actual fact, you don't know the cost of your borrowings at the start of the month. You actually only know at the end of the period. And what you actually do is you take a rate. So where I look at the 5-day look back, I'm referencing there. So for example, if you wanted to fix from the 1st of October to the 1st of December this year, you'll probably start, for the want of a better way of putting it, setting a rate 5 days before the 1st of October. And it will apply to the rate that finishes 5 days before the end of December. And then you've got a couple of days to do the calculations and pay your money, okay? So you will have no certainty in the cost per se looking forward because you will only know at the end of the 3-month period or 6-month period or whatever. It will cause a little bit of difficulty when you come to calculate it because it's backward looking and it can be compounded. And the market convention is also only evolving here. So I want to bring it to your attention more than anything else. We need more time to go through it in a lot more detail. Is it relevant in the Eurozone? Well, it could be because my last point there says the Eurozone is likely to veer away from Euribor as well towards what's known as Euro STR in due course. So this could come down the tracks in the Eurozone in the next couple of years. And it's also important to note that US dollar LIBOR. So if you had dollar loans at the minute, this side of the Atlantic, you'd be pricing them off US dollar LIBOR. Technically, it doesn't end until the 30th of June 23, but it will end on the 30th of June 23. But what I've noticed already is that no new US dollar LIBOR products will be issued from now on. So if you want to do a US dollar loan this year, you won't be pricing it off LIBOR because they won't allow it. And where this is also tricky is where it comes to interest rate swaps and things like that, because interest rate swaps work on a fixed rate versus a variable rate. The variable rate in the past was the 3-month or the 6-month LIBOR. You've now got to work it on a different basis with SONIA. So if you have sterling loans or you're likely to have sterling loans of dollar, you need to do some work in this space now because it's changing and changing quite dramatically. In sterling, if you just quickly look at how their fixed rates are going, and this is why the reason why I put this in is because this shows you how quickly rates start to move when they start moving. Okay, and what we can see here basically is the 3-year swap in the UK has increased by 1.5% in the last 12 months. Okay, so it was down below 0.2% and is 1.63% as of last Friday. And if you think about it, it rose by this amount almost before they had a base rate hike. They had a small base rate hike in December. So, you will get a movement of 1.25% at least in these rates before the ECB will do anything in the Eurozone. So again, all of this is saying is this is what will happen in due course. The UK are ahead of us. So therefore you need to wise up in the space of on the interest rate side. Okay. On the interest rate outlook side, I think the base rate in the Eurozone is estimated to, as I said, the most pessimistic thing I've seen is 2 base rate hikes this year. I'd say the majority of the market is calling 1 base rate hike maybe by December. So we're going to see it move from 0 up, but not hugely, and it will be slow. In the UK, we've had 2 base rate hikes already, and there will be more over the course of the year. But I said the States is the one that's probably troubling most people, because, as I said to you, it's varied from, I think Morgan Stanley last week were calling 3 hikes this year. Bank of America were calling 7 hikes in the States. And you're talking minimum of 0.25% in all those. And those moves and the variety of those moves really depend on what's happening, or to a large part, on inflation. So I've just listed here what the CPI, which is the retail inflation, is in Ireland, the Eurozone, the UK, and the States. And then I've shown producer prices as well, I suppose, because producer prices are an input into retail prices ultimately. So you can see, like, we haven't seen these inflation rates in quite some time. As I said, going back over 40 years in the States, and certainly going back, probably the last time we saw these rates in Ireland was Celtic Tiger times, but that doesn't necessarily give you a lot of comfort if that's our last comparator. And as I said here, the biggest danger here then in the interest rate front is that, we do get this inflation. It isn't transitory. It drives inflation, interest rates up, because they have to go up to try and manage inflation. And the real worry, there's a technical term, and some of you will be aware of, maybe not everybody, called stagflation. Stagflation basically means stagnant economic growth while inflation still persists. So the danger there basically is that you have to hike in interest rates to keep a lid on inflation, but hiking interest rates tends to slow down the economy. So you could have an economy that doesn't grow much, but is inflationary. And of course, the other real worry that they're worried about is that you get a wages prices spiral. So as prices go up, employees look for higher wages. As higher wages kick in, it's a higher cost of labor for goods and services, which pushes prices up, and you get that wages price spiral. And we haven't seen that now in quite some time here. So what I would say to you here is the biggest danger really on interest rate management is complacency, and a big proportional impact of small changes. What do I mean by that? Or what I mean by that is your cost of funds is 0 today and your margin is 3%. Your all-in cost of funds is 3%. If your cost of funds goes from 0 to 1%, that's not a big hike. A 1% hike in interest rates will happen very quickly. Your cost of funds goes from 3% to 4%. That's a 1/3 increase in your cost of funding. So in proportional terms, that's a lot. So I think, as I said to you, I won't over egg this anymore, but you get the message on this front here. But what I want to do here, just very quickly, if you don't mind, is just bear this in mind. And again, it comes to managing this stuff, that the impact of inflation on interest rates. So we can think of them very one-dimensional, or in single categories. But if we look at the graphic on the left-hand side first, I mean, inflation will impact on economic growth. It'll impact on equity values. It'll impact on exchange rates. It'll impact on wages, interest rates, bond prices. Its impact is right across the financial markets and economically as well. Okay. And as I said, because we haven't had to deal with it for so long, it's not been a major concern, but equally, when we've had it in the past, it's been a huge concern. And we're veering from, I suppose, one norm to the other here. And even within that, then with interest rates, it has an impact in a number of ways for us from a company perspective. I mean, the mortgage rates for our staff will increase if interest rates go up. That becomes a cost of living issue for staff, and that might drive wage increases. The cost of borrowing for the company obviously increases, because by definition, if rates are going up, it's going to cost us more to borrow. It can impact on pension valuations and returns, because when you look at pension valuations and that, you use a discounted rate, you discount out an interest rate. If the interest rates are increasing, then the present values decrease. It will impact on your cost of capital and your investment hurdle rate, because again, go back to studying this sort of stuff, your cost of capital is the cost of debt plus the cost of equity. And the cost of debt is your interest rate, or the after-tax interest rate. So if interest rates begin to rise, the cost of your debt rises. And in some companies, that will drive the cost of equity up as well, because some companies get adversely impacted more than others by rising interest rates. And let's talk about that, the stock market, as you know, at the minute, and a move away from tech towards value stocks. So you could be in a company where your cost of equity and your cost of debt increases in the next 12 months. And that means then that, the return that shareholders want, it gets higher, or it may mean less investment because you can't get the hurdle rates. And I've put in exchange rates there again, because you've seen from the earlier part of the presentation, interest rates and exchange rates are very clearly linked. So what I'm saying to you really here in the area of inflation and interest rates overall is, think of it in the round as well, the big picture. It's not just the cost of borrowing. It has a much wider impact on your business. And I think businesses are going to have to start thinking about this in a way they haven't thought about it probably for a decade and a half. Okay, if we move on then to the banking market, and no, some of this already. So we know there's a lack of competition. It's not good in the business banking market in particular. Corporate banking market is better served, but corporate banking really means loans of 10 million up. So most businesses are in that one, below the 10 million category, which is business banking. We've got KBC and Ulster Bank leaving. Now we have Permanent TSB resourcing up, and they need to resource up quickly because it would leave us with just 2 banks at the minute. The non-bank market is developing, but it's developing in niche areas. So we would have seen maybe non-banks step in, and then maybe some property development where banks weren't that active. We would have seen them in leasing, invoice discounting. So there are niche areas, but is it enough to plug gaps? I don't know. Second point is important here, the lack of resourcing. I would have a genuine concern about this because, as we know, the banks have undertaken significant redundancy programs, voluntary redundancy programs. And that means basically they're trying to right-size their business, if I can use that term, for how would they look in 5, 6, 7 years. The problem with that is you lose people immediately, but your business, if you think it's going to fall in scale, it falls over time. So I would be worried about that. I think the banks will be under-resourced this year. And what does that mean? It means if you're going to refinance anytime in the next 18 months, I'd do it sooner rather than later. Cash flow versus security is important. All lending is cash flow based now, but they will take security. But if your cash flow doesn't work, it's not going to happen. The banks are looking for better quality of information. There's no doubt about that. That's important. And also the ESG, which is, the whole environmental, social, and governance space, it's creeping in. And it's creeping in the sense that banks are now having to fill in part of their credit applications on ESG. So how it's going to impact is evolving. We're not quite sure, but it is evolving. It's something that banks are beginning to look at. If you're a bigger corporate, it's an even more important thing. It's coming down the tracks such faster. And where this could be a risk and an opportunity for smaller businesses is particularly if you're a supplier into a multinational. So the one I can just think of in general is, say you're supplying food companies into much larger retailers, international retailers. They're going to be on top of their ESG game, and they will probably look for their supply chain to become, I suppose, to hit higher metrics in the ESG space. So you may find as a supplier into some of these larger firms that you're forced to go down this route quicker than legislation, for example, will require you. So again, it's only emerging as what these norms will be, but it's coming down the tracks. And the problem, of course, is if you have to spend more money decarbonizing and stuff like that, it will cost. You'll have to invest. There's also an increased level of private equity availability in the market, which is driving valuations up quite a lot. A lot of money around there. It'll be interesting to see what happens if the ECB begins to scale back its quantitative. Well, it will. It's going to scale back what it's putting into the market and whether that will impact on private equity. But there are relatively low levels of leverage in the market. And I just put this up here. 2 graphs very quickly. This is lending to NFCs, is non-financial corporations. This is from the central bank. And this shows you basically, I set it at a base of 100. So in other words, taking 2003 as a base of 100, what lending to NFCs, basically that means lending to Irish companies, okay? But non-financial companies. And you can see from a base of 100 in 2003, it hit 300 by 2008. You're not surprised to hear that. It trebled in 8 years. That's why we had the financial crisis. But more importantly, look where the level is today. 2021, it's down actually below the 2003 level. And if I look at SMEs, which is a sub part of that, lending to SMEs, if I, on the left-hand side, I take again 2010, because I could only go back to 2010, central bank, on central bank site. So if we take 2010 as our base of 100, and remember that's off the peak of 2008, we are down now to below 50 in terms of the lending to SMEs. And in billion terms, we're down from about 26, 27 billion in 2010 to about 13 billion last year. So there's a very significant drop in lending to SMEs, and SMEs by and large are a lot less leveraged than they were. And this is my second last graph here. In fact, it's my last graph for the summary. Just saying this to you here, just watch this. This is again is from the central bank, and just showing you. This is the graph that on the left is what the current average rate is for lending to different sectors within the economy, and on the right hand side is the new lending in the last number of months. This is publicly available data, and I've ringed a couple of things to show different sectors where you can see the average cost of this is the cost of borrowing now, not cost of funds, cost of borrowing. What borrowers in these spaces are actually borrowing at, and you can see sectors where it's increasing and sectors where it's decreasing. But again, there's a wealth of information out there if you wanted to focus on it, and it's publicly available. So in summary, and I'm just looking at my time, I've probably a minute over, Mike, but I'm not too bad. Actually, I started at 8:02. I have until 8:47. Summary. So currency volatility, I think, is likely to persist, but it'll be driven by interest rate expectations. UK exporters, you're seeing some upside that you haven't seen in quite some time. Don't waste it. Bank some of this. The UK base rate, or sorry, Euro base rate is expected to remain static, but for how much longer? And I think for now, we should work off the basis that we'll see the first hike by the end of the year. We've already seen longer term rates increasing. And as I said, they've increased 0.25% over the weekend in the Eurozone alone. We've seen them increase by 1.5% in the UK in the last 12 months. So I would say to you, it might be a good time to refinance this year if your facilities mature in the next 2 years. I wouldn't wait. I think the cost of funding is going to increase. And as I said, my biggest worry is as much resourcing on the banking side. I just think they're going to come under pressure. It's going to take longer to do it. And I suppose the last point is also important. You need to invest time in your relationships with your lenders. You will need your lenders. Having good financing in place is an asset. It really is, because it's like everything else. You need to have good financing in place. Sometimes when you don't need it, because it's hard to get it when you do. So I would say to you, invest a little bit of time in your relationships with your lenders. It certainly pays off. And that's it. 8:47. I did 45 minutes on the nail, Mike. So I'll throw it back to you and see what sort of questions are coming in.
Delighted with that, John. Thanks very much. So what we'll do is there's a few questions after coming in, John. We'll just kind of take maybe just short answers just to get through a few of them. One of the questions is, given the EU sets the interest rates, what alternative measures could the Irish Central Bank or government take if they wanted to cool the economy?
Generally, if you want to cool the economy, you either reduce your spending or you increase taxation. So, for example, a jack up a VAT rate, that will reduce consumption because it's across the board, and that's generally they're the two tools that that the government would have. Yeah.
Okay, perfect. And just in relation to that, then, with the kind of, if inflation is going up, there's obviously going to be a demand for higher wages then, but that must be a kind of lagging factor then in it as well. Like that, obviously you can't get into a spiral then with it. Like, would that create a lot of tensions, you think, going forward with different companies and stuff?
Yeah, I think it's beginning to emerge already. Because you can see why. Like, this is why I have a problem with the transitory argument in inflation. The price of oil has gone from $32 a barrel in, at the start of the pandemic. It's $92 fairly recently. So, to say to somebody, I mean, mathematically, if inflation, let's say, take for the sake of argument, home heating. Let's say I could fill my tank for €500 12 months ago. It's now €800 to do it. Okay. If the price of oil and home heating stays at €800 in the next 12 months, inflation will drop to zero mathematically, because it won't have moved. But I'm still paying €800 for my fill that I was paying €500 for 2 years ago. Like, I still have to find the money somewhere. So that's why I don't agree with this transitory argument. And I think your point about the lag is well made. I think that's why we will see the inflation coming through, because I think that lagging effect in terms of people realizing, hey, my wages aren't going up fast enough. And the key thing here, Mike, and it's very important, is food inflation. Food inflation has been close to zero for over a decade. If food inflation begins to creep up, which, on the balance of probability it will, because packaging prices are going up, distribution's going up, and some commodities are going up, I think that's the key one to watch. If we see food inflation beginning to rise, I think the wage demands will be driven off that.
Okay, cool. That's very interesting. And I think one of the things is, as a non-expert in the area, it's kind of difficult when you look at it and there seems to be two camps. You've got the transitory nature, and I think a lot of the US economists are saying, well, no, look, inflation is here to stay. Is there any general reason why there seems, maybe it's just my looking at it as a kind of an ignorant kind of look into it, but there seems to be two very big camps on that almost. Is there any reason why that has occurred, or is it just a whole myriad of reasons that are coming into that?
I think the main one is probably supply chain. So basically, if you think about it, factories in the Far East in particular shut down with COVID. So if they shut down, they're not producing. And if they're not producing, then it takes them a while to catch up again. So you got that bubble in the supply chain. And of course, if you match that then with the fact that people's savings rates increased over the pandemic because of government supports. So you have on one side consumers who have money to spend, and on the other side, you have a production side that is catching up. So there's that bubble. So the transitory argument was this bubble will work its way out. It's a timing difference. And as it works its way out and it normalizes, everything will be fine again. The argument against it is, well, that's all fine and dandy, but you've got two problems. One is, what if it doesn't, as in you have this permanent upward move. And the second risk is what you've alluded to already. If you get into your wage price spiral, it gets out of hand. It's very hard to keep a lid on it. And I think, but that's why you have the argument between, I think, transitory and more permanent. But I think what you could have is more permanent, but maybe not going back to 6-7% that we saw in the 80s, but certainly back to 2-3%.
Yeah, and I suppose one of the things in them, these two questions are kind of linked. I don't know, one of them you mightn't be able to kind of answer on the spot, but just a general recommendation of what kind of reading would you recommend for, let's say, a chartered accountant, just something quick and regular that they can look at for updates on the treasury space with the big inverted commas around it. And then someone else has also asked, is there any way, would you recommend anywhere to kind of source examples of calculating cost of borrowing with the new Sonia system? Is there any kind of recommendations you could provide there or anything like that?
No, I have seen something on the Sonia one on some of the websites in the UK, and I can't remember which website. I can't remember. It could be there's a I think try ICE. There's a setting. The new Sonia rates have been set by ICE, ICE. Check their website. Check the Bank of England website. I'm sorry, I've actually looked at it in the last couple of weeks, but I can't remember which website I saw. And there was an actual spreadsheet that showed how the compounding would work. But it's almost, you need to get to understand the basics first, Mike. There's a number of variables there, and those variables need to be nailed down, and then you get your calculation. So it's almost like, what's my inputs first to then give me my output? But check those two websites, I think, for starters. If you had access to Reuters, obviously, or Refinitiv as they are now, they also have a section there. So that's on that one. On the other, sorry, the first question was on
just a general for chartered accountants, just looking for general short reading. Like, obviously you would kind of pour through a lot of data on a day-to-day basis, but for someone who's just looking for regular short updates, what general recommendation would you give for kind of following the latest trends, getting a capture of it in a short space of time?
To be honest with you, I would check the Corporate Treasury website. So you have an Irish Association of Corporate Treasurers. Now, our website wouldn't be as regularly updated, but there'd be stuff on it. The UK Association of Corporate Treasurers, which is, I think it's www.treasurers.org. They always have stuff on it because they'd be a far bigger association. I'm a member there since 1993, but they have thousands of members and a lot of full-time staff, and as you'd expect in the UK. And I'd probably use the two of them as references. There's also a European Association of Corporate Treasurers, EACT. They've got a website also. I think between the three of those, there's more than enough to get you started, at least in terms of what's topical. And I guess that's part and parcel of a lot of this, what's coming down the tracks, because that's what I'm just really trying to do a lot of the time, is just keep on top of what's topical.
I think just another more personal finance question that is coming in is now the time to start opting for fixed rate mortgages and loans. And I think you were kind of alluding to that. If you were saying to kind of, for companies maybe to fix for businesses, it's probably something that if someone is thinking about it from a mortgage perspective, they'd probably be thinking the same thing. I don't know if you have any comments on that.
Well, as you know, I can't give advice because the institute would kick me out for giving advice. But what I would say to you is, let's just say if I had just recently drawn down my first mortgage and I was young, what I would probably do is, first of all, I'd see if I could split my mortgage between a fixed and a variable, and that should be possible to do. So in other words, if you got a mortgage at 200,000, you could say to the bank, look, I want to fix 120 and keep 80,000 variable, because all they're doing is opening a second account and shifting, 80 from one into the other and applying a fixed rate to one and a variable rate. So I would always advocate that, because you want the flexibility that if you come into money or whatever reason, you want to pay down early, paying down fixed rates early can cost you if rates move against you. So you want that little bit of variability. So that's the first question I've asked. And I suppose the second thing, it really comes down to affordability. Like if there's not that much difference between variable and fixed rates, which I don't think there is a huge amount at the minute. No, I haven't looked at them in a while because I'm on a tracker. It's a legacy. I would say to you that if there isn't a big difference, the beauty of a fixed rate is that you know what you're going to pay for the next 2 years, 3 years, 5 years. So it almost comes down to what you yourself can afford and the certainty that it gives you. And I suppose if we thought that inflation was going to continue to rise and you said, look, I've got a mortgage, at least that's not going to rise in the next 3 years, assuming that you hold your job, your income holds up, you're hedging your outgoings to a certain extent there. I'd certainly say to you, it merits serious consideration now, is what I would say to you.
And then just something you alluded to in the presentation a couple of times was just companies in Ireland that, I don't know, was it relative to other countries or is it a culture thing? But you're saying that like the FX policy and that a lot of them don't hedge, like, is that a culture thing, or is it down to the fact that maybe they perceive the cost of engaging in it is not going to be worth it? Or is it that as you said, you were kind of saying there, is it that maybe it's a culture thing, they like a bit of a flutter or something like that in the currency markets? Is there any general reason behind that compared to other countries, or is that a country on country phenomenon, or is it something specific to Ireland?
Okay, first of all, I'd say you will find it in other countries, because and particularly in the UK, because I'm over and back to the UK quite a lot, and I would liaise with the corporate treasury guys over there. And I would say we lag behind them. In other words, they're better in this space than we are, but I wouldn't say they're exemplary. So if I said like 10 to 15% of a currency policy, maybe 25% there have. So why do we not do it? A couple of reasons. First of all, it's definitely down to the fact that we don't know where to start as accountants. Okay, there's a knowledge gap there. I think it quite often doesn't get the attention. So I found over the years, for example, I do a lot of policy work with boards, and I'm sitting on a couple of boards as well now. So I see it from both sides. And from my sitting with my non-exec hat on, I would want to see a treasury risk policy, a broader, not just currency, treasury risk. So treasury risk means looking at my liquidity, short-term and long-term, looking at my debt management. If I have debt, do I fix? How much of my debt do I fix? Back to your previous question. How do I manage my currency? How do I manage my interest rates? And people say, oh, you have to be big to do that. That's nonsense. Once you're in business, you have treasury risks. You mightn't call them treasury. You have to have liquidity because you need money to fund your business. You have money coming in every day and going out every day. That's cash management. You're either borrowing it, so you have debt management, or you have money on deposit. It's in surplus funds. And nearly every company is exposed to foreign exchange. So first recognize that these are risks and that you need to manage them. By putting a policy around them, all you're really doing is documenting, in many respects, documenting what you're doing, just tightening it up a little bit, okay? I think that what happens is I've noticed over the years that what prompts people to do policy is there's a crisis of some sort, either externally in the market or internally. So for example, when the Rusnak thing broke in the noughties, I got a weight of policy stuff because people said, Jesus, that could happen to a corporate, okay? And then after 6 months, it abated again. It's one of those things that I found over the years that is constantly number 4 or 5 on the priority of things, but it's never in the top 3. And you do the top 3 and it doesn't move up because something else drops up. So there's an element of that. Yeah, probably people think that, maybe can they justify spending a few bob on it? That's really for them to decide. I suppose the question I'd ask is, well, if you don't have a policy in place, how much are you willing to lose by not having one in place? Because I can guarantee you that there's no way that companies are spending more on doing a policy than they're leaking on the risk. I absolutely guarantee there's nobody that I've met over the years, because relatively speaking, and look, they can do it themselves. I'm not pitching here personally. I'm just saying you need to do it. That's my message. The message is do it. It's who does it or doing it yourself is not the issue. And the last thing I would say to CFOs in particular in this space, and sometimes it's not necessarily the right reason for doing it, but it's a good reason of getting them engaged, is that if you don't have a policy in place and something goes wrong in your finances, because you should have fixed when you didn't, you should have hedged when you didn't, your refinancing is not done quick enough, your backside's on the line because you're the CFO or you're the financial controller, okay? If you have a policy in place, at least if something goes wrong, the policy can protect you, okay? But it also means by having a policy, it means everyone around the board has to engage in that process. They've got to sign off on it because it's a board approved document. So you can't have the people who are outside of finance kind of abdicating responsibility. They've got to contribute to it, because as a director, you are responsible for risk. It doesn't say finance directors are only responsible for finance and the sales directors are not. That's not how the legislation works. So you need buy-in from the board, and quite often really you need the buy-in from the top, Mike. If your CEO is not on board, it's quite often very hard for the CFOs and the financial controllers to succeed in this space.
Okay, well, look, I think we're right on the button there at 9 o'clock now. So, John, I just want to thank you again on behalf of the Cork Society, and I want to thank all the attendees this morning. It was a really interesting webinar, and thanks very much for going through all that with us. So, listen, guys, thanks very much for that. The recording will be available again if people want to kind of go back in it, but I'll just wish you all now a good morning and thanks again.